I'm going to tell you something that's going to make you rethink everything you just watched happen to silver, and it's going to upset you because the mainstream coverage is lying to your face. JP Morgan just closed their massive short position in silver at the exact bottom of Friday's crash. Not near the bottom, not close to the bottom, the exact tick. And now every financial news outlet is running the same story, blaming the whole thing on the Fed chair nomination, on Kevin Walsh, on hawkish monetary policy, on anything except what actually happened. They want you to believe this was a normal market reaction to a normal news event. They want you to believe silver dropped $42 in a matter of hours because of a personnel change at the Federal Reserve. And if you believe that, if you swallow that story and move on with your life, you're going to miss the most important lesson about how modern markets actually work. I've been watching these games for 20 years, and I just watched one of the most blatant engineered flush jobs I've ever seen in precious metals. The London Metal Exchange went offline at the exact moment things got chaotic. HSBC, one of the biggest short players in the London market, had systems issues at the same time. CME Group raised margin requirements right when the trade was most crowded, most leveraged, most vulnerable, and they timed it perfectly, waiting until Asian markets were closing into the weekend so liquidity was thin and nobody could react. I can't prove they coordinated. I wasn't in the room, but I can lay out the sequence, the incentives, and the mechanism, and you can decide for yourself whether you believe in coincidences this convenient. Let me start with what you actually saw on Friday, because most people are still trying to process the magnitude of what just happened. Silver hit about $120 on Thursday. By Friday, it crashed to roughly $78. That's a $42 drop, about 35% in basically no time. It was the worst day in silver since 1980 by almost any measure you want to use. Gold fell hard too, down around 12% at the lows. Mining stocks got absolutely obliterated. The big miner ETFs were down 30, 40, 50% in some cases. Companies that have actual silver in the ground, actual reserves, actual production, lost half their market value in hours. The assets didn't vanish, the metal didn't disappear, but the paper value got wiped out because of how positioning and leverage work when the plumbing is turned against the crowd. And here's what you need to understand about the mainstream coverage. They're telling you this was simply a reaction, like markets politely repriced based on new information about who might run the Fed. That's not what this looked like. This looked like an engineered flush. This looked like a mechanically forced liquidation event that benefited the players positioned to survive it. Let me take you back to December because this matters. In December 2025, silver hit $84 during thin holiday liquidity. Margins got raised, silver dumped. I pointed out the pattern then. 1980, 2011, 2025, same playbook, same mechanism, same types of players, similar outcomes. Some people listened, some people ignored it. Well, they just did it again. But this time it was bigger. And if you understand the trigger and the tool they used, it actually strengthens the underlying thesis rather than weakening it. Because what happened Friday wasn't about supply and demand. It wasn't about industrial consumption or solar panel production or any of the real factors that drive silver long term. It was about paper. It was about leverage. It was about changing the rules in the middle of the game and watching the weak hands get crushed. Here's what the wealthy understand that you probably don't. The crowd doesn't get taken out by being wrong about direction. The crowd gets taken out by being leveraged at the moment the rules change. And margin requirements are the lever that changes the rules. When the exchange raises margin, they're not making a suggestion, they're issuing a demand. Every leveraged participant has to make an immediate choice. Option 1, deposit more cash right now. Option 2, sell your position right now. If silver is ripping and everyone is already maxed out on margin, if they're already using every dollar they have to control as much silver as possible, most people don't have extra cash sitting around ready to wire in, so they sell. And that selling pushes the price down, and that triggers more margin calls, which triggers more selling, which triggers more forced selling, and the waterfall feeds itself. This is why these moves look like panic, but a lot of that panic is mechanical. It's compulsory. People aren't choosing to sell, they're being forced. And margin is the tool that forces them. Now let me walk you through the specific sequence that happened Friday because the timing is everything. On Thursday, silver hits $120. The trade is crowded. Everyone and their grandmother is long. Retail is in, hedge funds are in, institutions are in, leverage is maxed out because when a market is running, people borrow more to make more. That's how bull markets work. That's also how bull markets end. Then Friday morning, the news drops that Trump has nominated Kevin Walsh as the next Fed chair. He's a traditional hawk, the kind of name that suggests less money printing, tighter monetary policy, higher rates. Tight money is bad for gold and silver, says the headline logic. Fine, that's the match, that's the spark. But a spark alone doesn't cause a $42 crash. You need fuel, and the fuel was leverage. Here's what the media won't tell you. At the exact same time the Fed news was hitting, CME Group was raising margin requirements on silver. I went digging through the CME silver margin data, and I couldn't believe what I was seeing. I searched around and found almost nobody talking about it. And that's insane to me because this detail is not a footnote, it's the lever that moved the entire structure. They raised margin requirements right when the market was stretched, right when everyone was maxed out, right when a small move could trigger a cascade, and the timing, they waited until Asian markets were closing into the weekend. Asia is roughly 12 hours ahead of the US East Coast. That means when the margin hike hit, liquidity was already thinning. Fewer buyers, fewer bids, less ability to absorb selling pressure. It's the perfect setup for a waterfall. Then the coincidences start piling up. The London Metal Exchange, one of the most important venues on earth for industrial metals pricing and hedging, went offline on Friday, just went dark. Systems issues, they said, at the exact moment of maximum chaos. Then HSBC, a major short participant in the London market, also had systems issues at the same time. Two critical pieces of infrastructure, both experiencing technical difficulties simultaneously during the most volatile trading session in decades. I'm not saying it's coordinated. I'm not saying I have proof. I'm saying if you wrote a script for how to engineer a crash, this is exactly how it would read. You'd create a hawkish narrative to justify selling. You'd raise margin to force liquidation. You'd take out key venues to reduce liquidity, and you'd time it all for maximum damage. Now let me be clear about something. I'm not claiming illegal activity. I'm not saying anyone broke the law. Margin hikes are legal. Trading halts happen. Systems go down. But when you see the same pattern repeat across decades, when you see the same levers pulled at the same moments, when you see the same outcomes for the same types of players, it's not random. It's a system. And the system is designed to transfer wealth from the leveraged crowd to the players who can survive the rules changing. That's what happened Friday. That's what happened in December. That's what happened in 2011. That's what happened in 1980. The names change. The mechanics don't. Let me explain why margin is such a weapon and why most people never see it coming. Silver trades in two worlds. There's the paper market and the physical market. The paper market is futures, mostly on COMEX. In the paper world, you're not buying silver bars, you're buying a contract, a promise of exposure, and you do it with leverage. You might control $100,000 worth of silver with $10,000 posted as margin. That leverage makes moves bigger. It also makes you fragile, because if the price moves against you, you have to post more margin. If you can't, you get liquidated. And here's the key that most people miss. The exchange can change margin requirements at any time. They can say, actually, we don't want 10% anymore, we want 20%, or 30, or 40. And when they change that requirement, they force every leverage participant to make an immediate choice, deposit more money or sell. If you're already maxed out, you sell, and your selling pushes the price down, which triggers margin calls for the next guy, who sells, which pushes the price down more, which triggers more margin calls. It's a chain reaction that feeds on itself until the forced selling is done. This is why technical analysis often fails during these events. People draw support lines. They say support here, resistance there. But when liquidation is forced, those lines don't matter. The selling doesn't stop because a line is drawn on a chart. The selling stops when the forced sellers are done. And that means if you're trying to catch the exact bottom with leverage, you're playing their game. In their game, the house always wins because they know where the forced selling levels are. Brokers and exchanges have visibility into positioning, leverage, and liquidation levels. They see where risk is concentrated. They know at what price the forced selling kicks in. I'm not saying that's abused. I'm saying the visibility exists. And that alone changes the game for the participant who doesn't have it. Now look at what happened Friday through this lens. The Fed news created the excuse. The margin hike created the mechanism. The outages reduced liquidity. And the timing into the weekend meant nobody could react until Monday, by which point the damage was done. Silver down 35%, gold down 12%, miners down 50%, billions in paper value wiped out. And who benefited? The players who were positioned to buy when everyone else was forced to sell. The players with cash, with dry powder, with the ability to absorb panic. JP Morgan closed their short position at the exact bottom. That means they were buying to cover at the lowest prices. That means they profited from the fall and then bought the bottom. That's not luck, that's positioning. That's understanding the game. Now let me address the most important question. Did this crash fix anything about the physical silver market? Did it create more silver? Did it reduce industrial demand? Did it solve the supply deficits that analysts have been tracking for years? No, 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 and no. The physical market is completely different from the paper market. Physical silver is bars, coins, real metal. It moves slower. It's driven by availability, real demand, real supply constraints, premiums, and logistics. You can pressure paper price with margin hikes and liquidation events. You can smash the futures market for a day or a week, but you cannot print physical silver into existence. You cannot suddenly create more metal because some hedge fund got liquidated. You cannot reduce the industrial demand from solar panels, electric vehicles, and data centers because of a Fed narrative. Here's the reality that the mainstream coverage is ignoring. The silver market has been in structural supply deficit for 6 consecutive years. COMEX registered inventory is down 64% from its 2020 peak. China is restricting silver exports as a strategic resource. Industrial demand from solar, EVs, AI infrastructure, and defense is accelerating, not slowing. And none of that changed on Friday. None of it. The paper price got crushed, but the physical reality remains exactly what it was before the crash. If anything, the thesis is stronger now because the paper market just demonstrated how fragile it is. The paper market just showed that it can be manipulated, that it can be smashed, that it can be used to shake out weak hands. And in doing so, it proved that physical is the only thing that matters long term, because paper can reset sentiment, but physical eventually resets reality. Look at what happened in December. Silver crashed to $84 on margin hikes and thin liquidity. The same playbook, the same mechanism, and then what happened? It recovered. It ran back up to $120 in a matter of weeks, because the physical deficit didn't care about the paper flush, because the industrial demand didn't disappear, because some traders got liquidated, because the structural thesis was intact. The same thing happened in 2011. Silver crashed from $49 after margin hikes. People said the bull market was over, and then it recovered and ran again. Not because of magic, but because the fundamentals hadn't changed. The crash was mechanical, not fundamental, and mechanical moves reverse when the mechanics stop running. Here's what you need to watch now. Watch the premium behavior. Watch what people are paying above the quoted spot price in places where physical demand is intense. The premium in Shanghai, for example, has been very elevated. That's not what you see in a market that is overflowing with easy supply. That's what you see in a market where physical metal is tight and people are willing to pay up to get it. If that premium persists or widens after this crash, it tells you something important. It tells you that the paper smash didn't fix the physical problem. It tells you that the real demand is still there. It tells you that this crash was exactly what it looked like, a mechanical flush in a leveraged paper market, not a fundamental repricing of silver's value. Let me bring this all together and tell you what this means for you if you hold silver, gold, mining stocks, or any precious metals exposure. First, you need to stop confusing paper volatility with physical reality. They are not the same thing. They are connected, but they're not the same. Paper can be smashed. Paper can be manipulated. Paper can be used to shake people out. Physical is different. Physical has to be mined, refined, transported, stored. Physical has industrial uses that don't care about margin calls. Physical has supply constraints that no amount of paper selling can fix. When you understand that difference, you stop panicking when paper gets crushed. You start looking for opportunities. Second, you need to get serious about leverage. I'm going to say this as bluntly as I can. Leveraging silver into a crowded trade when you know margin can change is not bravery. It's not conviction. It's volunteering to be the exit liquidity. It's handing the house a bat and asking them to hit you with it. The number one risk management rule is position size. If you're in something so big that a 10% move ruins your week, you're too big. If a 30% flush wipes you out, you weren't unlucky, you were over-levered. And in a market where the rules can change mid-game, over-leverage is a death sentence. Third, you need to think about what kind of exposure makes sense for you. If you believe the physical thesis, if you believe that supply deficits and industrial demand and central bank buying are real, then you might prefer exposure that doesn't get margin called out from under you. That could mean physical metal, that could mean less leverage, that could mean longer time horizons, that could mean instruments that don't mechanically explode under forced volatility. There's no single right answer, but there is a wrong answer, and that's being in a position where you can be forced out at the worst possible moment by someone else's rules. Fourth, you need to understand that we're going to see more of these events. A former London Metal Exchange market maker, someone who actually lived inside the casino, has said for years that in a structurally stressed market, you can see 20 to 30% dumps that are not fundamental. They're mechanical, they're liquidity events, they're forced liquidation cascades, until the market reaches a point where silver demand is meaningfully reduced. Whether through substitution, technology changes, or price-induced demand destruction, volatility is part of the package. You can't avoid it. You can only prepare for it. Let me leave you with this. The mainstream narrative is telling you that Kevin Walsh crashed the silver market. That's the headline. That's the story they want you to believe. But the deeper truth is that Walsh was the match. The fuel was leverage. The accelerant was margin. The outcome was forced liquidation. And the players who understood the game, the players who had cash, the players who could survive the rules changing, they just got very wealthy buying what the frightened masses sold. That's the real story. That's what actually happened on Friday. The question is whether you're going to learn from it or whether you're going to be the one selling the bottom next time. If this video opened your eyes to what really happened in silver, hit that like button right now, leave a comment and tell me whether you're buying, holding, or selling after this crash. Be honest, we're all learning here. And if you haven't subscribed yet, subscribe now. This channel exists to show you how markets actually work, not the bedtime stories they tell you on television. Now go look at your portfolio and ask yourself whether you're positioned to survive the next flush or whether you're the exit liquidity.